I'm Jonathan Alden. I lead the investor relations business at Vintage, working with our LPs and our partners. We have some on stage. We'll kick it off. We've got about 25 minutes. So maybe to start, I'll ask each of you to introduce yourselves, and we'll go quickly. What is your boldest prediction for venture in the next 5 years? Really quick hitter.
You want to go first?
Okay. Hi, everyone. It's great to be here. I'm Tilly Franklin. I'm the CEO and Chief Investment Officer at University of Cambridge Investment Management. We're a team of about 20 people, and we have one mission, which is to invest Cambridge University's investment assets, which is about £4.5 billion of very long-term investment capital. And my bold prediction is that exits and distributions will return to being a key feature of venture in the next 5 years at some point.
Okay, so hi everyone. First of all, thanks a lot for inviting me. I'm really happy to be here and to see so many friends, people that I know and also people that I don't know, so really happy to connect afterwards. I'm David, working with the European Investment Fund for more than 14 years now. So we are a European institution based out of Luxembourg, and we are managing and investing EU public money, mainly into VC funds. So I think we are the largest LP in the European VC ecosystem, having backed over the last 30 years more than 1,000 VC funds across Europe, and investing on average 3.5 to 4 billion euros of new commitments each and every year. So we are very active in the field, and what we see currently, and we've seen over the last 2-3 years, a lot of focus on climate tech, sustainability, which will remain, but we see also a lot of people willing to be active in deep tech. So depending on how you define it, it can mean a lot of things, but basically for us it's a lot about AI, space, defense, and all those topics that you hear and which also rely on the geopolitical situation in the world.
Thanks for having me here, Jonathan. Raja Doddala. I run the venture business at Churchill Asset Management. We're about a 50 billion or so in AUM private asset manager. Our businesses are private equity, private credit, and venture. My prediction for the next 5 years. I think the venture capital asset class, I think traditionally enjoyed anywhere from 800 to 1,000 basis points advantage over other private asset classes like private, equity. I think we're going to find out what we did in the last 10 years or so. And I think we probably will find, maybe hopefully it's temporary, that we lost that advantage.
Thanks. So we have a lot of GPs in the crowd, some in your guys' portfolio. I want to ask you, Tilly, I'll ask you first, but I'd welcome each of you jumping in afterwards. So many people are wanting your attention. What's a common misconception that GPs have of LPs that you would want them to know?
Okay. I was thinking about this. It's a really interesting question. So I think, anybody who's investing in software would expect any salesperson in any of their investee companies there's a sort of sine qua non to kind of spend time researching their customers' needs and, what the customer actually wants. And I think what's really fascinating to me is so few GPs actually really know anything about us or demonstrate really any interest in such. So, for example, we have a very concentrated portfolio across all asset classes globally. We have 55 fund managers. In venture, it's about a dozen. So it's quite unlikely that we're going to add a lot of new managers to our portfolio. Maybe if we kind of get really aggressive, it might be 1 or 2 new relationships per year. So I think, first of all, people should sort of not be offended if we don't want to meet up. But if we do meet, and we love being approached by people, we want to have good coverage, just as David said a few moments ago. But it is nice if you sort of spend a bit of time asking us about our program and what we're looking for, rather than just kind of going straight into the sales pitch. I'm always fascinated by why people don't invest more time in that.
Yeah. I think 2 main misconceptions that the GP have, especially when it comes to us, for instance, is that one, as an emerging manager, they shouldn't contact us yet, which is definitely a mistake, because we do a lot of emerging managers, especially by focusing on some verticals where in Europe you don't have that many experienced senior teams. So please feel free to reach out to us. And second part is that you should be knowing what you want to do and what you can bring, which is different. Meaning that if you just come and do a kind of copycat of something already existing, we do not have a particular interest in backing that kind of teams. We want to back teams which come with a differentiated approach, which have a strong USP, and which can make a difference. So should it be by focusing on a specific geography, sector, stage of development, or whatever. So they should always keep in mind that we are not in a kind of box-ticking approach. Just one concrete example, I remember on another conference, a lady claiming that, yeah, we are women-led, investing in climate. So we tick all the boxes, we should get the funding. And I said that's specifically why we will not invest. So please make sure of what you want to do, how you differentiate, and how you bring value to the market.
David, if I can push a little bit there, because I don't know the stats for Europe specifically, but there's something like 3 times as many venture funds as there are private equity managers. And if I do the miles to kilometers translation, that's like 3 billion funds, something like that. You talked about some ways where funds can actually differentiate themselves. What does that actually look like? And on the flip side of that, what's the easiest way to lose your interest when GPs are trying to get in front of you?
As I said, when it comes to the current focus and area of interest for us, we are a big fund, but we do not have a legal entity to do so. We manage money on behalf of various entities, and the largest one in our part is the European Commission. So it comes with a number of strings attached, and mainly the fact that we are combining, for each and every investment we make, the financial objective with the policy objective. So we need also to align with those political objectives which have been designed by politicians in a way, and we are the investment arm to make it in a kind of professional way. So we need again to have people not only claiming that they want to do something, but capable of convincing us and providing us with enough comfort to take a commitment. And then we can be anchoring those strategies, but they need to contact us. And we don't have a kind of predefined minimum or maximum fund size or ticket size. We adapt on each and every case. We can go basically from 10 million euros ticket from up to 400 in some extreme cases where it's a specific mandate for later stage big tech funds across Europe. So it's very diverse, but we again need to make sure that those teams and those players are already of interest for the market.
Sure. And for many reasons that were discussed already over the last few years, especially post-COVID, those large managers ended up being the benefit of a lot of flight to safety, so to speak, and also just growing into larger funds. Raja, how do you, for your portfolio, how do you assess whether a GP is actually scaling responsibly? And can you give an example of maybe somebody that nailed it?
I don't know that I have examples, but I think it's definitely a very confusing time for LPs. As VC as an asset class used to be small, boutique asset class, and now there's 5, 6 different kinds of seed and pre-seed products, and then there's multi-stage. That's, it's not the size per se, but it's the complexity of the product. Multi-stage firms are now doing seed, and they're doing A, and they're doing growth, and they're doing continuation. They're doing all these other products. There's specialist funds and there's generalist funds. It's become a very confusing. I think the size is one thing. It's, we've all seen how the math kind of gets hard when you're, this is what I was alluding to earlier. When a 2.8 or 3x net in 10 years, that's hard to do currently, and that only gets you to low 20s IRR. And that's just has to do with size, and now there's all these confusing products. That's to me that's a bigger problem than fund sizes getting really big. It's just the venture has become complex and confusing for LPs.
Yeah. So I think, and we heard it at the end of the day, each of us and what we do, it comes down to the relationships that we have and how we make that unique, and ultimately whether that's the sourcing or the relationship that you have with LPs, from your perspective, Raja, and curious to hear from the group, what makes a GP-LP relationship particularly exceptional and unique, and what brings you back continuously to the LPs that you work with?
I would say the first component, which was already mentioned in an earlier panel, is transparency. You need to be informed in advance when things go well, but also when there's something coming up which is not that well. And then you can try to find a solution, because when you're just exposed to the situation, if you have not been warned in advance, it's always the more critical.
And for me, transparency, yes, but I would also add communication. The GPs we have in our book that we're closest to, that we do more with, co-investments, or when the next vintage comes around, makes it easier, is to constant communication. Some of them do it informally. Some of them do it. For example, Abe and I have a monthly touch point that we never miss. It only takes 15 minutes, but we're constantly caught up. So it's finding a way to keep each other really informed really helps.
I would agree with both of those points, but I'd also say an ability to adapt, because it's such a fast-moving environment. So if you to have a multi-fund relationship, obviously we want people to remain true to their sort of core principles, but to adapt to the changing environment is also key for a long-term relationship.
Yeah. What do you not care about that people talk about a lot? What just doesn't make a difference for you?
Everything makes a difference.
I don't know, podcasts. just way too many of them.
Alan, we got to scrap that vintage podcast that we're going to launch.
Yeah. No, I think what makes really a difference is when you have some people who come and have a kind of fund model to show you how they intend to deploy the fund, and with very high expectations. We would all love to have that kind of returns.
Yeah.
But how does that align with their track record? Is that something which is really realistic in a way? And as I said, we've backed more than 1,000 funds, so we have a huge internal database, which is even more extensive than all the ones you can find on the market. And to some extent, we have people coming and saying, okay, we'll generate a 10x return at the fund level with some outliers, and the worst performing will be returning 5 times the commitment. So, can it really be something true? It just can't happen. It never happened.
Yeah.
If they found a magical formula, great, but doubtful.
I'm going to jump around, but because you said that, we heard, I think yesterday and over the past few days, when the idea, I was talking with one of our partners here, the idea of risk-taking as a fund, we want to underwrite 3x or 10x or whatever it is, because you're going to miss a lot, and the average expected return of that fund is going to be sometimes and most times lower than 10x. As an LP, that's not the risk that you're trying to take. I won't ask you to call everybody out in the room, but what does a good returning fund look like in your guys' portfolio? And what is a realistic expectation when every fund comes and says, we underwrite to a 3x, we underwrite to a 10x? What does that look like in your portfolio? What does a fund need to hit for you to say, this is one of the best managers that we have?
And it's hard to say. I thought you were going to ask about just portfolio returns in venture, because I can tell you exactly how we actually model our asset allocation, which is our venture asset class should be 200 basis points over buyout, and buyout should be 600 over developed equity. So it's an 800 basis point premium. That's how we model it, which is obviously very garbage in, garbage out. But that's the whole portfolio. So obviously there's going to be a huge spectrum of fund performance in there. So some funds won't deliver against our expectations and some will. But I think for an early stage venture firm, it has to have the potential to be an outlier. But we don't expect every fund to be that. But it's like a portfolio of options. It's really very similar to the venture manager's task in terms of portfolio construction. But
yeah, I think one very important element is DPI, especially in VC and in Europe. So this is the first element, and then again, being realistic and having a robust model, meaning that we will never ask a GP to stick to the line. There was 7 lines in the model. You need to make 17 investments, but to understand how they see the evolution and to have a kind of rigorous approach, not just doing anything on an opportunistic basis. It looks maybe great, but it's hard to understand, to sell, and to convince then us also for the future.
Sure.
I think one thing that I would add, it's an interesting point that David made earlier, especially if you're investing early, seed or pre-seed. It's difficult to know whether you're picking the right ones or not, because the time horizon is such a long time horizon. But in today's environment, I think the expectation is if a venture fund achieves a 3x net of all the fees, probably would be top decile. I think the most obvious ones in our book that we think are going to get there are David's absolutely right. Picking companies at a super early stage is an art, but there's one thing that is actually in your control, and that is price. So the most obvious 3x net managers in our book are the ones that really deeply care about price.
Can you hear me? Oh, there we go. We're in Europe. Let's talk about EU. Sorry, Europe. Sorry,
Because of
Brits. You almost stepped in it.
Yeah, Europe's been in focus over the past year. You both have invested so much in, or you're based here, and you've invested so much in the ecosystem. David, can you give some examples of kind of what's been in style? Who do you think is taking the right approach to Europe, or what do you think is the right way to actually be thinking about investing in venture in Europe overall?
In my view, something which is quite clear is that we're going for more and more specialization, meaning that, again, when it comes to early stage, even in Europe, you still have quite some money available for the entrepreneurs. The purpose would be for us as LPs to select the ones that have the better chances of being selected by the entrepreneurs, meaning that they will have to bring something on top of the money. And this is added value. And although you can bring added value by having a generalist approach, especially in our case with some specific policies to follow, we are convinced that we need a number of specialized players. Not only them, but for sure we need to have on the market, especially at early stages, very highly specialized players which will help the companies to set up in the right way to become then attractive targets for a bit later stage investors. And by later stage, even Series A focused investors can be those ones. But at least when it comes to seed investment, you need to bring something specific to the entrepreneurs.
Tilly, what do you think LPs are getting wrong in Europe?
I really couldn't say. I'm sorry, I haven't got a particular take on that.
Sure. And maybe I'll ask you, we're seeing a lot of multi-stage managers. You mentioned sector-focused managers. Do you think the pendulum has swung too far to big-name funds, multi-stage managers? How do you think about that in your own portfolio?
Yeah, I mean, as David mentioned earlier, clearly the multi-stage managers are just sort of sucking up a lot of sort of the landscape, as it were. So from our perspective, what that means is that there's a real barbell approach in our portfolio. So either we're with a very small number of these larger managers or very, very early stage managers. I think it's really hard, in the middle there to be a sort of generalist Series A manager. It's getting harder and harder. And I would say actually on the European point, I think it's even harder because each individual market obviously is smaller than large homogeneous markets. So in Europe, it's even more of the barbell. It's either the sort of larger multi-stage managers or like super, super focused early stage managers with small AUM.
Raja, we heard about, Tilly mentioned IPOs coming back over the next 5 years at some point. We're hearing from a lot of LPs about the pressures in their own portfolio to allocate capital. Can you describe to the crowd, for you specifically, how is that actually affecting your ability to allocate risk capital and in venture specifically?
No, it's a real problem. I think especially mature venture capital programs or private equity programs, once you start investing in year 7, 8, 9, it's supposed to be sort of a self-funding sort of mechanism, and that's been broken over the last 2 or 3 years, and it's definitely making our jobs a little harder. And also, I think the narrative that we've been hearing, either the IPO market is closed, or it's the SEC, or it's the FTC. I'm not sure that's true. It's probably a combination of that and abundance of private capital and all the proliferation of venture products in late stage venture products and a lot of the LP money going into. So we'll find out, in the next 2 or 3 years if that's the case or not. But what we're doing is we're proactively asking our managers to have at least write a provisional exit plan for each of the companies, and that's sort of common in private equity, but it's not in venture. I think the venture capital industry should take that advice, and some of our managers are.
Sure. We jumped through the quantum realm. We went from 4 minutes to 1 minute immediately. So I'm going to ask maybe to wrap up all of you guys. What's the most unique pitch that you've gotten from GPs that's kind of gotten your attention? Anybody want to start?
Yeah, I think the ones which come with the ambition of changing the world. But then how do they intend to do that? And you have a lot of diverging views on that. Some of them more exotic, I would say. But we've seen some very convincing speeches over the years. And some of them are doing very well. So we need also to believe at a certain point in time to not only to have all the concrete and factual elements, but also to believe in the teams.
I don't know if it's unique, but this one manager tracked me down on Twitter, LinkedIn, Facebook, Instagram, Strava. We didn't commit.
So persistency is helpful for attention, but maybe not for capital.
No.
It's hard to summarize in a soundbite, but the unique pitches are the ones that come with a unique insight, and it's incredibly unusual.
Sure. Well, that's all the time we have. Negative 15 seconds. Thank you for joining me, and thank you, everybody.
Thank you.